Let's start. Welcome to today's policy panel of the Inflation Conference. Let me quickly introduce myself. My name is Sabrina Marggraf. I'm a journalist. I'm based here in Frankfurt, and I'm the moderator of this policy session. Well, for many years, inflation has not been an issue for citizens, mainly because inflation rates have been stable for decades. But as we heard earlier, it is a good and important time to talk about inflation because, as you all know, the topic of inflation has become the talk of the town again. And if you look at the tabloids, they report about rising food and energy prices basically on a daily basis. But what exactly has changed and what does it mean for the inflation outlook? We'll speak about the upside risks, of course, and whether the rise in inflation will be temporary or permanent. And it seems like inflation is proving more stubborn than originally anticipated. So in the next 45 minutes, we talk about the inflation drivers and expectations, and of course, about monetary policy for both the euro area and the US. But before I bring in the panelists, just a brief reminder that you're more than welcome to participate. So I'll invite you to submit your questions. We will have a Q&A session at the end of the panel. Okay, so let me introduce the panelists for today's policy session, although that I think they actually don't need an introduction, so I'll keep it short. I'm very pleased to have Loretta Mester joining us from Cleveland. She's President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. Welcome, Loretta. Can you hear us?
I can. Thank you. It's great to be with you.
So, virtual welcome to you to Cleveland. And I would like to welcome ECB Executive Board Member and Chief Economist Philip Lane, who's joining us from Frankfurt. Welcome, Philip. Good to have you with us.
Good afternoon.
So now I can see you, which is great. Let's dive in with the first topic and with the first questions. I would like to talk to you about the communication of central banks first. And central banks, that's obvious, are changing their communication. They try to be more accessible, probably for reasons of accountability and public trust. But to which extent would you say it is necessary for people to understand monetary policy and your mandate? And would your policy be less effective if people had no idea about central bank policy? Philip, maybe you want to start.
Okay, so I think obviously we spent a lot of time on this issue in our recent strategy review. And of course, I'm going to put to one side the fact we also have a parallel communication exercise, which is always fundamental in relation to explaining to our professional counterparts in the financial system, in the banking system, and so on. So I know the question is not really about that. And if you think about the public at large, I think you already, in the question, highlighted some key issues. Is so much is going on. So much has been going on in the last decade. Central banks have clearly got a much bigger footprint these days through the balance sheet, through all of our policies, that it's important to give people a sense of why we're doing this, and fundamentally a reassurance that essentially our kind of code word is stability. And I do think, and of course, there's going to be similarities and differences between the euro area and the US on some of these topics. But for the euro area, it's not just about the pandemic. It's also about the fact that Europe went through a heavy double crisis 10 years ago. And I think what everyone in Europe really wants is really to be assured that we're going to be a source of stability. And that, if you like, is fundamentally about price stability for us. But behind that is, in order to deliver price stability, you have to make sure that you avoid really significant risks to the overall economy. So I'm kind of doubtful too much about how much people, the typical person needs to know about the nitty-gritty of everything we do. But I very much hope, and I do think it's important, that the typical person has a favorable view. They trust that we are delivering our mandate. And in turn, do they have to know the exact details of the mandate? I think behind that is that we are a source of stability. And I suppose I do hope and think that the last year has been a vivid demonstration that the ECB is a source of stability, especially when it matters most, which is a crisis episode.
Loretta, would you share that view?
So I think I share that view with Philip, not surprising. I mean, central bankers have been on this journey of trying to explain ourselves and explain what we're doing and why we're doing it. I also agree with Philip that, you know, you have to pick your audiences. You will communicate differently to different audiences. But the key thing is that we have to appear to be credible in what we're doing. And the public has to trust that we are going to hit our, in the US, we have a dual mandate of maximum employment and price stability. And it's very important for policy effectiveness for the public to understand that that's what we're aiming for and that we're setting policies to you know, foster those goals. I think the other thing that is very important in the US context and probably in other countries too is, you know, we know from a lot of research that monetary policy is much more effective when the central bank is insulated from short-run political considerations. And in order to maintain that independence, which is like a privilege, right, it's really important that the public, you know, can really hold us accountable. So I think it's incumbent upon policymakers to really explain as best we can, you know, to a lay audience what we're doing, why we're doing it, what our goals are. And otherwise, we're not going to be able to maintain our independence and actually setting policy. And I think those pressures, you know, they ebb and flow over time. You know, sometimes we're in a more sort of political environment. I think some of the tools that we've used in this crisis and in the previous crisis kind of raise questions. And I think it's just incumbent upon us to always be out explaining what we're doing, why we're doing it. And I agree with Philip totally. You know, we're about stabilization. And so it's important that the public understand that. I always think of communications as being a journey. You know, we're never there. We can always do better. And, you know, I think we're all working to do that. I mean, we have the center, which is one of the sponsors on inflation research. A part of that center is really geared on trying to explain like these really hard concepts of inflation and price stability and price levels to a non-technical audience. And they have some interesting content out there, and I urge people to look at that.
And currently you have a lot explaining to do about central bank policy, about monetary policy, especially to, let's say, the normal people. And many citizens don't understand is when you look at inflation, rates have been way above the respective targets. Would you say that they are just temporary or are they more permanent? How do you explain that there's no change in monetary policy, even though inflation rates are rising and people feel that?
So that's a quintessential question, right? So I ran into this great quote by Carl Brunner this morning, which really is apropos. So we suffer neither under total ignorance, nor do we enjoy full knowledge. Our life moves in a gray area, so partial knowledge and partial ignorance. And right now we're in a situation where both supply side and demand side factors are influencing prices. So there's really increased uncertainty around the inflation outlook. And one question that policymakers have to ask themselves is whether that increase in inflation we're seeing this year is telling us about inflation over the medium and longer run, or said differently, how much of that increase is driven by supply shocks and how much of it is driven by demand that would respond to monetary policy. So you're right, the measures of inflation are up. You know, we've seen increases in inflation expectations, mainly at the shorter end, as opposed to long run inflation expectations, which are more telling about underlying inflation. And so far, much of the increase in inflation this year has been driven by, components that are really tied to the pandemic, whether it be a supply chain issue or, just a surge in demand after the economy reopened. So you can point to those things as saying, like, these things are not going to be the kinds of factors that mean that inflation is going to continue to go up. And so my baseline is that we'll see inflation rates move back down as pent-up demand eases and supply side challenges ease. But as you know, that's taking longer than people thought. So, and in some cases, the supply chain issues are getting worse. So I see the inflation risk is tilted to the upside. And, in my mind, if we see inflation continue to move up, if we see the longer run, medium run inflation expectations moving up and really jeopardizing being anchored at levels consistent with our goal of 2%, I would take that as indicative that the demand side factors weighing on inflation are stronger than we anticipated them to be. And indeed, the only way for those things to continue to increase is that it's coming from the demand side. And in that case, policy would have to react. But at this moment, I don't see that as being the baseline, but I'm attuned to those risks. At the same time, we have to recognize that all the factors that weighed on inflation in the last cycle, globalization, the fact that we're near the zero lower bound, and that gives you a bias to low inflation, technological change, all of those are still present. And so that's the challenge. The challenge is to really understand, is it being driven from demand side considerations, or is it being driven by supply side? Right now, my view is it's pandemic related, but we'll have to wait and see.
Philip, where do you see inflation risks? Are they on the upside in the Eurozone as well? And when is inflation going down again?
So here, it's super important for central banks to be as clear and as straightforward in their assessment. Because, obviously every day there's headlines, and of course it's dramatic to focus on the latest, monthly reading and so on. But as Loretta already indicated in the US context, we do. We have so many analysts. We work so hard to understand what's going on, and it is the case that I think we should not be buying into a narrative of who knows, or uncertainty is so pervasive that we have no idea. That's not the case. There's very solid reasons to believe a lot of this is to do with the reopening of the economy. There's very solid reasons to believe there's a significant transitory component. And then I think maybe differentially between the US and the euro area, demand conditions are not in the same place in the euro area as the US. If you look at very basic structural indicators, such as the fact euro area has a chronic current account surplus, the scale of kind of fiscal support is different, even though, of course, it's been a significant support for the European economy. And very importantly, as you look ahead, for example, even with fiscal, there is a very natural, organic fiscal correction coming, as a lot of the supports that were there are going to roll off. So when you look beyond the month-by-month data and you think about the medium term, you have to think about the headwind from the fact there will be an offsetting fiscal policy dynamic. And also I would emphasize, and probably as a fraction of the total inflation dynamic now, it's maybe more in Europe than in the US, which is an energy shock. And the energy shock, we've been here before. Energy shocks are, of course, in the headline data, they push up energy prices, very important. But it's also by and large contractionary. It's a headwind for the economy, especially for a net importer region like the euro area. This is something, of course, we have to track, not only in terms of energy prices, but the macro consequences. So I do think we should be just, maintaining and explaining to everyone this is an atypical situation. the reopening after the pandemic. And on top of that, the overlay we have, which is the increase in energy prices. And again, this has been a long-standing recurrent cyclical issue. And so we just have to, again, keep on maintaining this distinction between how we think about adverse supply shocks. And it's so different to, if you like, steady state inflation. And then going back to, it's an interesting phrase, which is a very natural phrase about the direction of risk. We still have inflation in the medium term well below our inflation target. If inflation moves up a little bit towards the target, that's a stabilizing move. So it's a very different situation. The red zone, I think, for everyone is if inflation became persistent at a number which is not, immoderately above the inflation target. And that's a very far distance from where the euro area is. So, I do think we have to be the counterweight, honestly, in this debate. We have to just be repetitive, consistent. Now, when I say consistent, it doesn't mean our ears are closed, our eyes are closed. We obviously look at all the data coming in. But there's so many interlocking reasons to think there's a significant transitory component. Again, this does not mean, I don't think it's a super interesting debate about to say when is the turning point? When is the peak? How quickly does it fall? But it goes back to our medium-term orientation. It is so important that we make sure that inflation stabilizes at 2%. Doesn't stabilize at below 2. It stabilizes at 2 in the medium term.
There's an increasing uncertainty in the post-COVID environment. The winter is not there yet, and we don't know what happens with the virus, even though there is a vaccine now. Is that an uncertainty an argument for rather accommodative monetary policy, Loretta, or do you see a need for a preemptive move by the Fed to keep inflationary pressures at bay?
Yeah, I don't think I would say preemptive. I mean, in our strategy statement, we still, emphasize in our new strategy statement that, there are times when the goals may be, countervailing one another rather than complementary. And so we're going to have to balance those goals as we think about the future. I mean, again, it's really, as Philip said, it's what your forecast is for inflation, right? The FOMC put out forecasts last time, and they basically show that, yes, inflation is going to be quite elevated this year, well above 2%. But then we have our forecasts are that inflation is going to move back down next year as some of these supply chain conditions, work themselves out, and pent-up demand works themselves out, and some of the things that Philip said about, fiscal policy being less of an impetus. So in that forecast, if you look at what the FOMC put out as their baseline, views across participants, right, the funds rate, right, is very accommodative for much of the period. So there isn't really a view out there that we need to be aggressively moving up interest rates, because we want to make sure that the recovery is intact. On the same time, you have to react to the evidence that's out there. And if you look at the beginning of the year forecast of inflation from the FOMC and the summary of economic projections, they were quite a bit lower than they are now. And so I think, you have to sort of evaluate what the causes of the increased inflation is, as Philip said, right? I agree with him that, there's a lot of evidence that suggests that it is supply and pandemic related, but you also have to be willing to sort of look at what's happening in the economy and evolve your, views over time. And I think one thing that happened in the US is when we set out the forward guidance on the funds rate path, at the, last year, September, after we put out the new framework, I think most of it at that time thought that we would be hitting the inflation goal from the downside. That, in other words, we would be meeting our goals over time, but it would be inflation rising up to 2%, given it had been low in the last expansion. And what's different now is that inflation is well above 2%. So again, I think you have to always evaluate where inflation is going and match, your policy prescriptions to the longer run goals that you're trying to achieve. So I don't think I would call it anything like preemptively trying to do something. Our new strategy says, look, we're not going to be moving until we have average inflation being 2%. We're going to be now making up some of the past misses. I think we've basically met that part of the mandate. I think maximum employment, we have not met that mandate. So, my forecast is that we'll meet that mandate, but it'll be at the end of next year if things play out the way I expect.
Philip, the Fed might start tapering most likely before the ECB even considers withdrawing stimulus. How will that affect monetary policy of the ECB?
I mean, obviously, the world has a kind of very integrated global financial system and an integrated global economy. So global conditions clearly we look at, but it's very important. I try and emphasize this all the time. The euro area is a large continental-sized economy. It's the economy and the financial system is euro-denominated. So there isn't, if you like, a kind of mechanical pass-through of dollar financial conditions to the euro area. And so really there are two forces. One is, there is obviously some crossover in terms of the bond market, and there will be a positive correlation in yields. But there's also the exchange rate channel. So this is the point about the fact that the euro, our financial system in euro, has this divergence from the dollar financial system, depending on what happens to the exchange rate. So it's two forces working in opposite directions. At some points in time, obviously at the start of the year, I do think there was a spillover in terms of the yields, and we responded to that. At other times, the exchange rate channel can matter more. But the bottom line is, no matter which channel is operating, let me emphasize, in the end, I mean, the ECB will respond to that. So it might be a headache for us in terms of our policy calibration, depending on what happens. But from the point of view of the ultimate inflation dynamic, that's a detail, because in the end, the ECB can endogenously respond to it. I do want to I do think it's important to come back to the uncertainty point you asked, Loretta. So I'm going to come back on that, because it is a big part of our strategy, and it's reflected in the forward guidance. What does our forward guidance say? It says, the forward-looking component is we're not going to be trigger happy in response to forecasts, because the world is uncertain. We shouldn't overweight the forecast process. So this is a very important point. Now, I do think forecasts still matter. So what we've said now is essentially not only is it the end of the horizon, but also more or less the midpoint of the horizon will play a role. But the second point is you also want to look at what's going on, as Loretta said. But very importantly, it's more important to look at underlying inflation than headline. So if you see and I've mentioned to you, a very large fraction of the current high inflation rates in Europe are energy driven. And this is something we have to look through. We have to look through this, and it's only if we see enough dynamic in underlying inflation will the conditions be met for us to move. And this is where going back is, the fundamental is the European labour market has not heated up in such a way that we are seeing any kind of significant wage pressure. And this is something, of course, we'll track, we monitor. But this is, again, we're different parts of the cycle, I think, between where we are in Europe and the American situation.
let's talk about the inflation expectations. People are starting to pay more attention to the inflation. It has become the talk of the town. That change in expectations could pave the way for more permanent price increase, like those famous second round effects, for example. Do you see a risk that the change in expectations could pave that way?
To me or to Philip?
Loretta, please start.
I mean, the new strategy we put out really leans heavily on anchoring inflation expectations, long run, medium term inflation expectations at levels consistent with our 2% goal. And so it is important for us to monitor what's happening with inflation expectations. And you're right, the short run inflation expectations have moved up. But those largely are driven by some of the one-off salient prices that Philip is talking about, gasoline prices, some food prices. They typically drive short-run expectations. The longer-run measures of inflation expectations have moved up a little bit, some of them, but back to levels that we would say are consistent at 2%. Remember, in the last cycle, they had moved down in 2014, 2015. And so, the fact that they're moving back to levels consistent with our goal is actually a positive. I think your question is, well, what if we continue to see them move up? Will that, generate inflation? What if we continue to see inflation move up? And that goes back to my first point, was that can only happen if, right, it's coming from the demand side. You wouldn't expect that to continue if the shocks are coming from the supply side. So again, we have to be very attuned to what's happening with inflation expectations, because they tell us something about, what's happening in terms of what's the inflation drivers. But right now, I agree with Philip, the main drivers are pandemic related drivers, which are not really going to feed through to underlying inflation. Which is what we care about. On another point about this that, economists, we like to say we want to look at underlying inflation. Unfortunately, the public has to pay those prices of food and energy. And so that's always a bit of going back to communications, that's always a communication problem for us, is how do you explain that, we care about those prices. Our goal is headline inflation, total inflation, which includes those. But we're trying to look a little forward. We have to be forward looking because of the nature of monetary policy only affecting the economy with a lag. And that's where, really understanding the underlying inflation rate comes into play. But it is a challenge for communication.
Philip, have inflation expectations in the Eurozone moved up as well?
So, I mean, I think, again, it's important to highlight the difference here, which is, it's very important for us to actually re-anchor inflation expectations at 2. So it was clear inflation expectations have drifted down. I mean, that's from the point of view of the, people involved in the financial system. You can look at either the survey professional forecasters or the market-based measures. I'll come to that in a minute. And then when you think about behavior of workers, of households, of firms, these are unobservables. They're expectations. You can do surveys and they can be very informative. But basically, one very important way to extract where inflation expectations are is basically wage dynamics. And what we had before the pandemic is we did have a significant improvement in the European labour market. Unemployment had gone down quite a bit. But essentially, the wage increases workers were looking for, they were looking to improve their real wages, but they were basically based on inflation projections, probably around low ones. So we do need to have a situation where inflation expectations go up. And there is a significant move this year in terms of the attitude of the financial professionals. You see that in the swap data and so on. But I think the way to interpret it, which is very important, very welcome from our point of view, is the narrative that inflation would stagnate, below 1 or stagnate around 1, that is given less weight. So now there's more weight given to the fact that, in fact, the inflation dynamic may be in the high ones, but it has not gone to 2%. I mean, I do think the kind of campaign to stabilize inflation expectations at 2, it's not there in terms of the financial market participants, and it's not there in terms of the broader economy, because otherwise we would see much stronger wage negotiations, for example. So I would say we're coming from below on inflation expectations, and I think that that's important. While of course always keeping an eye on avoiding the red zone, where expectations kind of go into an unstable process. So I mean, what's interesting, and I think I see it everywhere right now, is the inflation is no longer a totally dead topic. But I mean, for us, that means instead of people saying, when inflation's so low, it's totally unimportant, people are now starting to think about it. But they're thinking about it in the context of, what is inflation in the medium term of 2? What does that mean? And also temporarily a bit above 2. And I think that was always going to be a necessary stage. The fact it's happening at the exact same time as we also have temporarily high inflation, that makes life complicated. I don't disagree, but I mean, but I do think we have to maintain that distinction between the short-term surge versus the fact that the job is not over by any means in terms of stabilizing expectations at 2% for the medium term, in our case.
I would like to give the floor to the audience for their questions, and I have a couple of questions. And the first one is by Yuri Gorodnishenko. I hope I did get that one right. Professor at the University of California, Berkeley. Yuri, what is your question?
Thank you. We touched on this a little bit, but I wanted to draw your attention to one fact I see in the data, which is inflation expectations of households and firms increased quite a bit in recent months. But on the other hand, we see that professional forecasters and financial markets see few reasons to worry about future inflation. I was wondering how you interpret these divergent views, and if there is anything you should do in terms of policy in response. Thank you.
So I'll start and Philip can jump in. I mean, so there is a lot of research, and you've done some of it, Yuri, about sort of the divergence of expectations across different agents, right? Consumers, businesses, professional forecasters, but even within consumers, there's a lot of heterogeneity, across. If you cut the data by demographics, you'll see differences. I mean, I think a lot of inflation is an experience good, right? You might have expectations based on the purchases that you're making, whereas professional forecasters, I think they take a longer, they're thinking about it in terms of monetary policy and that medium to longer run view. And so I think that part of what's happening is the survey questions of what we're asking in some of the surveys and the responses you get back are going to be different for different actors. But as Philip said, you have to go beyond the measures of expectations and ask questions of how is that actually impacting wage setting, price setting. In the US, there's a lot of upward pressure on prices right now, but wages have risen, but they're still, it's not a problem in the sense that productivity is also up. So real wages haven't gone up as much. So again, I don't think it's that surprising that there's divergence. Even though it does present challenges to our models, I don't think it's too surprising that you see that divergence. It may be that we're not communicating well, even with our survey tools, and asking the kind of questions that would get at kind of the underlying inflation expectations that we might be more concerned with.
Philip, do you want to jump in here?
Yeah, I mean, I think the data Yuri was referring to was probably US-based data. Now there is, I know, say in some household surveys in Europe, there's also a significant movement in inflation expectations. So let me make a couple of points. One is the connection, I suppose, to the overall inflation dynamic. It is until I see it, because you should see it in wage data. You know, if there was a serious, you know, population-wide belief that the medium-term inflation expected inflation rate had gone up, you would see this in wage negotiations. We're not seeing it yet. So until I see it, I think that element, I think I'm going to pause on. But even regardless of that, I fully respect. I mean, I think there's a lot of evidence that this may spill over into consumer behavior, because you know, if people perceive inflation to be high, it's a loss of real income. You know, and that loss of real income may in turn lead to lower consumption, for example. So I mean, there is a kind of recessionary or counter the narrative that there's a very strong economic dynamic inevitable now from that. But maybe behind that, and which is consistent, I think, with the fact a lot of this energy is Europe is facing a terms of trade movement. Europe collectively has a loss of real income because of this. And, you know, this is something which is a headwind for the European economy. So if you like, people are not wrong when they see they pay more for their home heating, for their transportation and so on. That is a genuine loss of real income, and that has macroeconomic consequences. So I would tend to say, look, we need to look at that dimension, not just the mechanics of how that maps into just a narrow the topic of inflation. And of course, in turn, the macro through all sorts of channels has indirect effects onto inflation.
Let's move on to the second question. This is from Katrin Assenmacher, Head of Monetary Strategy Division of the European Central Bank. Katrin, please. Katrin, can you hear us? Katrin, I'll try again. You should get an invitation to unmute yourself, so maybe you can give it a try. Okay, so let's move on to the third question.
I now got an invitation, so it just arrived.
Oh, hi.
Sorry for the delay. It just came through. No, you talked a lot about negative supply shocks and that central bank should look through these negative supply shocks. And now we're probably faced with a sequence of negative supply shocks, which drives inflation up more persistently. And my question would be, at which point should a central bank start to act? And would this point be different following now the review of the strategy in the Fed and also at the ECB? Thank you.
Well, you want to go first, or you want me to?
Okay, I mean, I can go. So I think there's a couple of issues. One is, of course, there's a long literature about second round effects and the correct response and all of that. But of course, one basic difference between now and the 70s, the 80s, and so on, is the low equilibrium real rate and the shadow of the lower bound, which basically does speak against moving too quickly. That the balance of risk of going too early versus being too late has clearly shifted. So I mean, I think, Katrin, it's captured a lot by our own forward guidance that, you know, those conditions need to be met, you know, to see movements on our rates. And so, you know, I think we need to see, we don't, it's not a case of saying it's possible that we'll have second round effects. We need to see it. We need to see actual underlying inflation moving. So, you know, I think we need to wait to see that, as opposed to make a conjecture which may or may not be correct. I think we need also, honestly, with second round effects, to have a more refined view of that. I mean, there's a big difference between, if you, let's say one version of the world is there's a one-off price level increase, and it needs to be a one-off wage level increase, nominal wage level increase. That's very different to a spiral or a locked-in situation where there's an extrapolation where that kind of a pandemic unexpected movement in levels is extrapolated into every year there's going to be more inflation than we expected, and therefore every year we need to increase our nominal wage negotiation. So one-off, so I'm not, I also, my criterion is not, that wages, if wages move up to compensate on a one-off basis, that is not locking in permanently higher inflation dynamic, which would need a response. So I do think we have time to see what's happening in the labor market, and again, I think have the patience to do that. While again, always making the permanent remark, we keep our eyes and ears open, and we're always permanently reviewing what we see. Okay.
I would agree with what Philip said is, one of the motivations for the review in the US of our strategy was the changes in the underlying structure of the economy, one of them being the lower R star, and then changes in inflation dynamics where, there's a less empirical tie between this, constraints on, slack in the labor market and in the economy and inflation. And so that downward bias to inflation expectations means that all else equal, we'll be running a more accommodative policy. And, I agree with Philip, that means that, we're going to be more patient than we would have under the old strategy here. But fundamentally, if it's supply shock driven, right, that's not something that monetary policy should be responding to. It's really, it's got to be, do those indicators tell us something about the level of accommodation, i.e., is it really telling us something about the demand side? And so far, we don't see that. And I totally agree with Philip, the price level may be higher, after the supply shock, but that's not an underlying inflation acceleration situation where we have to take action. So I think we always want to calibrate our policy, but again, the North Stars are the goals that we have, in the US maximum employment and price stability is measured by 2%. So I think hasn't changed under the new strategy. I think that's been the case. It's just we're going to go about it a bit differently than we did before.
I think we have time for one last question. This one is from Bart Hoban, economics professor at the Arizona State University. Bart, the floor is yours, if you would like to unmute yourself.
Thank you, Sabrina. I wanted to follow up on Yuri's question. There's a recent paper by Jeremy Rudd at the Board of Governors that kind of challenges the paradigm that inflation expectations actually matter a lot for future inflation. And I thought Yuri's question was very nice about what should we look at. So I hear we should look at wages. Now, wage setting in the US is very different from that in the United States. So if we're thinking about household, business, and financial market inflation expectations, still the question is which of these are then a better indicator of the inflation expectations that will be manifested in future inflation. And so what are policymakers, especially in the United States, looking at out of those three?
Loretta, do you want to start?
Yeah, I mean, that was a very interesting paper. I ran across it, and it's a fun read. If anyone hasn't read it yet, it's a very interesting read. And yeah, he brings up, some issues about underpinnings, even the theoretical underpinnings of, long run inflation expectations is telling us much about the actual inflation rate as sort of questionable. So, and the empirical support he cites as being lacking. I think probably, there's a lot to what he says in terms of the theoretical underpinnings. that we have to be careful about. But on the other hand, I think he probably overstates things. And so we still want to look at the kinds of indicators we looked at before, including wages and including longer run expectations. I don't think we should throw out all those models. But again, I think they're indicators of the calibration of policy, right, to meeting our goals. So those indicators are important for telling us, again, you know, are we on track with our policy? Are we too accommodative or not accommodative enough to hit our inflation rates over the longer run? So I'm a big believer in looking at a lot of different indicators and looking at a lot of different models, because I agree with Philip. You know, we've learned that, well, I think we always knew this. I'm not sure we learned it, but you know, you can't pin everything on one model, and you should be model averaging and looking at the outcomes of several models and also doing scenario analysis. So I'm not sure I'm answering your question, but I don't feel that Jeremy's paper undermines the whole wanting to anchor inflation expectations. I think we have seen that when they become unanchored, we end up with worse economic outcomes. And I don't think that's changing anytime soon.
So let me offer a comment as well, which is basically the paper by Jeremy Rudd is very, of course, focused on the US. And really, I mean, I think that the cross-country comparison really just provides such overwhelming evidence that inflation expectations matter. You cannot explain the differences in inflation dynamics between the US, the Euro area, Japan, take those three regions, without accepting that fundamentally, now it's a low frequency, but that's the catch. You know, these low frequency persistent components, if they become de-anchored, it's very hard to re-anchor. And you know, you know, month by month, you know, looking at the kind of, and I'm sure there's a lot of non-linearities. So, you know, 1.7, 1.8, 2.2 is very different from 2 to 1, and staying at 1 for a decade, which is more or less what happened in Europe. And so, you know, I think a simple cross-country comparison just really highlights that this component is such an important part of the overall inflation dynamic. And in the end, each of us has to look after our own monetary area. So in terms of policymaking, you know, I think the points Loretta just made, you know, I agree with. But the basic, you know, of course, maybe dramatic claim that inflation expectations are kind of over weighted, I'm not so sure. I mean, I think it's pretty fundamental.
So I think we're at the end of the policy panel, and the next session is just waiting right around the corner, and I think it's about inflation expectations. So it would be quite a good topic, next topic after this discussion. So what's left for me is just to say thank you very much for your input. Thank you very much, Loretta, for joining us. Thank you very much, Philip, for your time. I just wave goodbye to you both. Thank you very much to the audience for your participations, for your patience, and all that's left for me is to say goodbye. Have a good evening, a good day, and see you soon.